Hi and welcome to our summer energy market update. Today we'll be taking a quick look at what's been driving prices, what to watch out for, and what it could mean for your energy strategy. Geopolitical risk is still a major driver of volatility, especially in energy markets. Just recently, tensions in the Middle East pushed prices up by 20% in a matter of days, showing just how quickly sentiment can shift. Despite a fragile ceasefire in late June, tensions in the Middle East remain high. Any renewed disruption, particularly in the Strait of Hormuz, could trigger supply shocks and threaten global LNG and oil shipping routes. On top of that, Ukraine's domestic output has been hit by Russian attacks, so it's now relying on European gas imports to refill storage from record low levels. Both could squeeze supply in Europe and push prices up. At the same time, tariff threats from the US are fueling volatility. Whilst recent US-EU agreements have eased some concerns, unexpectedly high tariffs on other countries continue to raise fears of weaker global demand. Trump's latest proposals, including higher tariffs on countries trading with Russia, are adding further uncertainty. If no peace deal is reached, they could take effect by mid-September. The tariffs aim to pressure Russia, but countries like India and China, major importers of Russian coal and oil, may struggle to source that supply elsewhere. Any retaliation could trigger a trade war, potentially dampening global demand and pushing energy prices lower. The LNG market remains structurally tight due to reduced Russian gas flows, surging European demand and conflict risk in the Middle East. In early 2025, European gas prices stayed at or above Asian hub levels, boosting European LNG imports, which are expected to increase by 25% in 2025. The good news is that Europe's storage picture is improving, with injection rates broadly on track to reach 83% by the 1st of November. But we're still exposed, especially if we see unplanned outages in Norway or if LNG diversions continue due to heat waves in Asia. Extreme weather is playing a growing role in energy markets, affecting both supply and demand. Prolonged heat in Europe over the remainder of summer may raise gas demand for cooling or reduce nuclear output, as higher river temperatures make reactor cooling more difficult. Looking ahead, the ongoing hurricane season could impact US LNG exports, which are a key supply source for Europe. And whilst it's too early to call the winter forecast, there are signs that a colder than average winter could develop due to factors impacting the strength of the polar vortex. We'll cover that in more detail on our autumn update. On the policy front, the UK has ruled out zonal pricing under the REMA programme, keeping a single national energy price. Whilst there are still many unknowns, this does give some certainty around how energy will be priced going forwards. More details on the delivery plan are expected this year, with reforms expected to continue through to 2029. Carbon prices remain strong, partly due to an agreement between the UK and the EU linking their emissions trading schemes. On top of that, supply cuts as part of the Market Stability Reserve mechanism and free allowance cancellations for the aviation sector will put upward pressure on prices. This tighter supply has caught the attention of investors and is something we'll continue to watch closely. With so many moving parts, from geopolitics to weather, it's clear that energy prices could stay volatile through the rest of summer and into the winter period. If you're on a flexible contract, increasing coverage for winter and beyond will shield you from some of this volatility. For fixed contracts starting in October 25 or April 26, now's the time to act. In a volatile market, opportunities can disappear quickly, so being prepared is key. If you've got any questions or want to talk through your energy strategy, we're here to help. If you'd like more updates like this, head over to our insights area on our website, tridentutilities.co.uk, for more useful content. Thanks for watching.